Okay, hello everyone. Welcome to another example or another installment of Ask the Professor. I have an interesting question this week, another interesting question I should say for this week. This one had to deal with, our question about inflation. Now, this question about inflation isn't how to calculate it in the past, or how much it's been over the last week, or last month, or last year, or whatever, which we've done many times in class, but rather a question about calculating or finding out what inflation would be in the future, because we've got to make future decisions. Okay, as soon as you say the magic word future, especially in macro, we're talking about estimation, we're talking about guesstimation. I don't know any economist that does. If so, if I could find a model that worked exactly, could tell me exactly what it would be, we would be rich. I would know exactly what to buy, whether to sell short or buy long on the futures markets for bonds, etc., and we would be wealthier than Warren Buffett. So the real question might be what causes it and where there are hints or signs of it. So that we can talk about, and that's kind of stuff I will share with you. Alright, the first thing I'll have to say is what are signs of potential inflation coming? Okay, there's a couple signs. One, if the Federal Reserve starts acting to increase interest rates, what's called cutting back on the money supply, that is a sign that they are seeing 9 months or 12 months down the road potential inflation. Also, if you see large purchases of inflation-proof, quote, assets, precious metals have been that for many years. Now, don't confuse that with the panic in 2008 and the gold was bought up. Gold spiked there in 2009 and 10 and has come back down to some degree since then. But usually people buy precious metal. Real estate was one for many years. Of course, that's got its own little bubble issue recently. But for example, in the 70s, we studied the inflation in the 70s. That is what people did. If you had real estate, you had an asset that went up with value along with the prices. So, okay, prices went up, but so did my asset, so I still was better off. I mean, think about it this way. Suppose you worked hard this summer, you get $1,000. You say, oh great, I got $1,000. I'll put it in my checking account, just leave it there. Or I put it in a shoebox, might as well. What's the difference? Right? And leave it under your bed. If there's inflation, the value of that $1,000 is getting eaten away at, right? It's getting shrunk. So smaller and smaller, your value starts coming down. So what you want is an asset. So if instead I put it in gold coins, I buy $1,000 in gold coins, if there's 12% inflation, well, that also means that those $1,000 of coins now are going to be worth what? More, maybe $1,120 or whatever. So the coins are going up, the assets are going up. Same thing, a house. I buy a house at this price. Now there's inflation, but the inflation means the price of the house is going up as well. And again, that means my asset is gaining value. And so you see lots of money shifted into those. You'll hear about, basically wealthy people that are all transferring into these sort of inflation insurance or inflation-proof assets. Another sign of it would be a long period of economic recovery where you start to see low unemployment rates, very low unemployment rates, and you hear about a tight job market that, not a specific industry, but rather even just across the board, employers finding it hard to get employees. That is a sign of potential inflation, and we'll talk about that a little later in the course, but it has to do with the fact that the definition of inflation really is that there's too many dollars chasing too few goods. So if production isn't enough to meet demand, then prices are going to start to be pushed upwards. And that's the big sign of that. And that's one of the concerns, by the way, why the Fed, of course, knows about it, is doing it, is that the Fed has pumped a lot of money into the system over the last few years. You say, well, there's a lot more dollars, and there's not a lot more to buy with it. That should be causing inflation. It would be, but of course, thanks to the crisis in the banking system and everything else, that money isn't being used like it normally is. It's sort of just sitting there in the system. So basically, they're pumping all this extra money in just to try and get some of it to get out and do what it's supposed to be doing. As the economy has continued to recover, or at least improve, we can see the Fed has announced that they want to cut back. They want to get that extra money out before there would be a chance for that to be inflationary. Whether it'd be successful at it or not, who knows, but they certainly are concerned. It's not like they didn't know that this was a risk, and so they're keeping an eye on it. All right, what to do about inflation, or if there is inflation in your future, what to think about? There are a couple things. One, you can check out there is a bond, inflation-proof bonds, offered by the Treasury and others. Now, what this bond does is basically guarantee a set real interest rate. So let's say it's inflation plus 1 or inflation plus 2. So that means you buy this bond, and if this year inflation is 3%, then you'll earn 4% on your bond, or 5. If inflation is 10%, then you're guaranteed 11 or 12, inflation plus 1 or 2, 11%, 12%. If inflation is 0, then you earn 1% or 2%. It guarantees you beyond inflation. So no matter what happens with inflation, it will keep the gap, a little bit higher, and you get that. And that's the kind of thing that is offered out there. So that's the kind of thing you'd be looking for in terms of those assets. Excuse me a second. The last thing I would say about inflation is, or things to check for inflation in terms of its value, again, also has to do with what are people doing in terms of the difference between fixed and variable rate. Let me explain. You can get a loan and someone say you're locked in at 5%, or we'll give you a variable rate loan at 3%. That sounds like, well, gee, why would I want to pay 5% on a loan instead of 3%? A fixed loan means the bank or the lender is taking the inflation risk. If I agree to pay 5% and inflation next year ends up being 8%, I'm paying 5%. That's my deal. That's what I locked into. On the other hand, because that would affect interest rates. So as interest rates go up, there you go. But we know inflation going up, interest rates would go, nominal interest rates go up, but I'm on a fixed rate, so who cares? A variable rate, the reason why they give you a better deal is that you, the borrower, now take the risk, right? Now you're the one that's in danger. So if inflation happens and that pushes up interest rates, so could the interest payment you have to, right? And it wasn't just the balloon payments that caught a lot of people off guard with the housing bubbles in 2007, 8, and 9, but it was also when there was a big credit crunch and interest rates started shooting upward. People who could pay their mortgage before, all of a sudden their interest rate shot up because it was variable rate. That's why they got such a great deal. And boom, they could not make those payments. They could have if they had a fixed rate. So again, it's one of those things to consider. So if you see a big gap between those, you can see that the banks are certainly betting on whether or not there's inflation or not concerned by how much risk they're encouraging others to take. In other words, how much of a deal are they giving you to be a variable rate? Because that's usually a sign that they don't want to be the ones responsible. Okay, well, it was a good question, and I hope this answer helps you out.